Welcome to my last pincast on partnership accounting. So our goal is to learn how to liquidate a partnership. And there are 3 steps that you have to take. First, you got to sell off all remaining assets and allocate gain and losses. Then, as always, pay off creditors first before partners, and then pay off capital balances of existing partners. I need to write down some facts, and we'll move forward from there. So here's some facts for you. We have a partnership. I made a little worksheet of the balance sheet. We have cash and non-cash assets totaling $340,000, and they equal our liabilities plus our 3 partners' equities. Go ahead and check the math, and you'll see that I'm in balance. Let's run through our 3 steps. Sell off the assets and allocate gains and losses, paying off the liabilities, and then pay out the partners. And in our first example, let's assume that we sell the non-cash assets for $350,000. So a little bit of a gain. I'm going to make my journal entries right on this worksheet. And I'm going to post the gain directly to the capital account because I don't want to take a gain and then take it to income summary and then do a closing entry for it. I'm going to take a little shortcut. I think you'll like it. Watch how it happens. So I sell my non-cash assets. I get $350,000, so I debit cash. And I credit my non-cash assets, and I have a $50,000 gain. And let's assume that our partnership shares things 3 to 3 to 4. So I have to split that $50,000 gain in a 3 to 3 to 4 fashion between the existing partners. That puts $15,000 for my 30% to A, $15,000 for my 30% to B. 15 and 15 is 30. I have to get to 50. Need another 20, and 40% of 50,000 is 20. So where are we after this transaction? I have $390,000 cash. I have no more current assets. I owe $25,000 in liabilities. Partner A has $130,000. Partner B has $115,000. And partner C has $120,000. Take a second and check the math, and you'll see that I'm in balance. And this would have been the journal entry I made to sell off the non-cash assets. And then I would have closed it into the partner's accounts. Our second step, if you recall, was to pay off debt. And we have a debt. We have some accounts payable. So we'll take $25,000 out of our cash and pay off our liabilities, dropping both sides. This looks like the worksheet we did in 1110 in the first chapter. You remember it? 390 minus 25 is 365. No other cash assets, no liabilities. I still have $130,000 cash in one partner's account, $115,000 in the other, $120,000 in the last. Now take a second and check the math. So we want our worksheet to balance since we're kind of taking a shortcut. 130, 245, 365 it does. And then the third step is when you often mess up. You pay off the capital account balances. You don't split it in accordance with their profit and loss sharing ratio. We're already done. We did that in step 1 when we sold off the assets. Then we paid off the liabilities. Now, step 3 is to pay out the capital balances. No more gains, no more losses. These partners are all exiting, and we're going to write them a check. Going to spend $365, credit cash, and debit partner A for $130, partner B for $115, and partner C for $120. And just like that, I have no cash, no assets, no liabilities, and no partners. There'd really be some journal entries, one to record the sale of assets. We did that in the last chapter. A simple one to pay off accounts payable, and a check written to each one of our partners to pay off their existing balances. And all is well. That ends well. Wouldn't you say? Except when it doesn't. Let's look at an example when one of the partners' accounts has a deficit balance. Let me draw down some facts. Let's see that example with the deficit. We have assets of 40, other cash assets of 300, accounts payable. And if go ahead and run a little check, and you'll see my balance sheet equations in balance. And let's say that we sell the non-cash assets for a miserable $200,000. Oh, what a bite. First, we have to sell the non-cash assets, as you'll recall, which we just said we did, and allocate the gains, in this case, losses. So rather than make a journal entry and then put it in income summary and close it, let's just see how it would look. The other assets need to go down for 300. They're gone, and I only got 200,000 for them. So I've had a loss of 100, and as you'll recall, we share 3 to 3 to 4. So I need to split that $100,000 loss between my partners. 30,000 is going to go capital A, 3/10, 3 and 3 and 4 is 10. 30,000 going to capital B, and 40,000 going against capital C. Oh my gosh, look what happened to him. Now we have cash in the amount of $240,000. No cash assets. We owe $25,000 in accounts payable, and capital account A has a balance of $85,000. Capital account balance B has a balance of $145,000, and C has always been causing us grief. They're down to a negative $15,000. Well, we still have to pay off the current liabilities, so we'll take the second step. Pay off debts, but I'm worried. $25,000 out of the checking account to pay off our accounts payable. Be a journal entry to credit cash and debit accounts payable, down to $215,000 cash. No other assets, no liabilities. $85,000 in capital account A, $145,000 in capital account B, and a deficit in account C. The third thing that needs to happen is to pay out capital balances, except there's a problem. Somebody needs to pay in. And as is always the case, there's two possibilities in accounting. One, they pay up the $15,000. We have a happy ending. Or two, they run out on their debt, take off to some place with a beach, and leave the other two partners holding the bag. Let's assume the first scenario. Let's do that first case. In the happy case, partner C puts $15,000 into the business to take care of that deficit, and that leaves $230,000 in the checking account. No other assets, no liabilities. $85,000 for partner A and $145,000 for partner B, and nothing for partner C. And we get a payoff. The balances. Let's do it. Write the check for $230,000, wipe out the cash, give $85,000 to partner A, $145,000 to partner B, debiting their accounts, crediting cash, game over. Nothing left. Partnership successfully liquidated. And that would be a happy ending. But what about if C, who's been causing grief all along, runs out? Let's see what that looks like. So here's where we are. We started with these balances. We sold our assets at a loss. We allocated the loss among the partners and according to their profit and loss sharing ratio, which is 3 to 3 to 4. That left capital account C with a deficit balance, paid off our accounts payable, and we currently sit right here in this sad and sordid situation. We've already done step 1. We've already done step 2. We sold the assets. We allocated the gains and losses in 3. We're supposed to pay out capital, but we can't. And in this case, we're going to say partner C disappears and doesn't pay anything. A dastardly deed. That leaves one more loss for the two partners to share, a $15,000 loss. So we need to go back to the profit and loss sharing ratio. Since C's no longer in it, there's only 3 and 3. 3 and 3 is 6. 3/6 to capital account A, 3/6 to B. One more loss for the poor partners to absorb. Relieving partner C of his obligation. Where are we now? Go ahead and bring the numbers down. Well, we're still in balance, so we can write the checks for $215,000, zero the checking account, pay off partner A, pay off partner B, and end the sad and sordid tales. Partnership over. Nothing left. So we sold the assets and allocated the loss. We paid down the accounts payable. We couldn't pay the capital because that didn't happen. There was a loss to absorb. I'm going to quickly make these journal entries so you'll get a chance to see them. Let's go back to step 1 where we sold assets and allocated a loss. Step 1, you sell the assets. And that would be debit cash. And credit non-cash assets. For $300. Now we picked up these two numbers, 200 and 300, and we would have a loss on disposal of $100,000. And that loss would get closed in income summary. Isn't that obnoxious? Aren't you glad we didn't have to do these? A loss has a credit balance, debit balance, so we'll credit it. Take that to 0. So we sold the assets, and then we did the closing entry. And these two entries I was able to do on my worksheet in that one line. So we've sold the assets and we've closed them. Now we need to close income summary. I did my entry backwards, didn't I? I did. better fix that so you don't get confused. Income summary, loss will be credited because it's got a debit balance like expenses, and income summary will be debited, and loss credited is 0. We'll get there. Then I have to close income summary to the related partners accounts. Income summary is a temporary account. 30,000 and 30,000 and 40. Somebody's making coffee. You take that entry, post it, and between these 3 entries we accomplished what I did on this one line. That's why I like the worksheet. And all of that was sold to assets and allocated the losses. The next entry series, that was line 1. Line 2, paid off accounts payable. Pay the accounts payable. So we've done the first one. That one's easy. Debit accounts payable, 25,000. Credit cash, 25,000. And you can see that on my worksheet. Then, on line 3, I had to absorb that other loss because I had a deficit in one of the partners' accounts, and he did not make it whole. So, capital for A and capital for B are both going to go down to the 7,500. And in a sense, they're contributing for partner C to take his balance to 0. And we have this line accomplished. And the last line's to pay out the partners. So we're now down to pay off the partnerships. It just had to take care of that deficit first. Line 4, pay out the partners. Capital A, capital B, and cash. Capital A got 77,500. B 137.5 and wrote the check for 215. So line 1 sold the assets, did the closing entry, closed it to the capital accounts. Line 1 was a busy line. It did all of those things. Line 2, paid off the accounts payable. And line 3, paid off the partners. Well, line 3, I just can't get it right, can I? Paid the deficit in line 4. Line 3 paid the deficit in line 4, paid off the partners. I chose to make the journal entries for the hardest one, but I'm almost sad I did, because I sure had trouble keeping track of the entries on the worksheet. Worksheet's much easier. I like it.